Hel- Hello, everyone. My name is Gabriel Vera, and I will be facilitating this session 3 of stream 3 of REFA Festival 2021. The stream focuses on emerging trends in economic thinking, and the theme of the overall festival that I'm sure a lot of you guys are aware by now because you've probably went to quite a few of the sessions, is the economic responses to COVID-19. We've had a lot of exciting speakers already in different sessions, and I'm very excited to see the presentations that we have lined up today. This session is focused on finance and financialization. So it's a really exciting topic, and we've had a lot of people register to be a part of this one. So I think that we can get underway, and we will be starting today with a presentation from Dr. Nina Eichacker. Dr. Nina Eichacker is an assistant professor of economics at the University of Rhode Island, Kingston. Her work examines the nexus of post-Keynesian economics, international political economy, and economic geography in questions of finance, monetary policy, and government actions. She has published in Challenge, the Review of Political Economy, the Review of Keynesian Economics, and the North American Journal of Economics and Finance. And her book, Financial Underpinnings of Europe's Financial Crisis, Liberalization, Integration, and Asymmetric State Power, was published by Edward Elgar in 2017. Her presentation will be entitled Structural Financial Power and Monetary and Fiscal Space, a preliminary comparison of core and periphery. Sorry, Dr. Eichacker, just 1 minute before you start presenting, I messed up. I'll just explain the format of the session. We have at least 2 speakers today, and each one will have a presentation that's around 15 to 20 minutes. And please use the question and answer tab to put questions in there for any of the speakers. And we'll get to that in the Q&A portion at the end of the session, sorry. And that's an hour and 15 minutes long. So I'm really sorry, I took a lot of the momentum out of my introduction for Dr. Eichacker. I hope she forgives me. But yeah, I think we are a go.
All right, well, thank you again, Gabriel Vera, for hosting me and inviting me to participate. It's really a pleasure. Thank you everybody who's attending this session to be here. So I'm going to share my screen with my presentation, and you'll give me a moment. Okay. So if it's all right with everybody, I'm not going to go into full screen just so that I can keep tabs on time. Okay, so I should start by saying that this presentation is largely about big comparisons between more powerful economies and less powerful economies. And it's thinking about the intersections of finance and state expenditure and monetary policy in general. So as a result, it's going to be talking more in broad strokes, comparing core and peripheral experiences, rather than delving into sort of national level dynamics. So the organization of this presentation is going to start by linking the notion of fiscal space to monetary power and structural financial power. And when I talk about structural financial power, I'm thinking here about the importance of finance for a given economy in ways that are linked with financialization, but we'll talk about that in a little more detail as the presentation goes on. And I'm thinking here about the factors that determine the likelihood of a financial crisis becoming a fiscal crisis of some sort. So if we think back to the 2008 global financial crisis, and specifically what Adam Tooze has described as the transatlantic financial crisis, or the transatlantic crisis, what we saw was a dynamic in which big financial crises turned into fiscal crises for certain economies and did not turn into fiscal crises for other economies. And so what I'm trying to think about broadly is what factors make a financial, what factors increase the propensity for a financial crisis to turn into a fiscal crisis? And how should we think about the roles of banks and other financial intermediaries, central banks and governments in that process? So to this end, I think we should be thinking about the relative openness of a financial system and the relative financialization of of the economy. And I'll again delve into what those terms mean shortly. But I'm also thinking here about the relative propensity or ability of a central bank to backstop banks, the relative ability or willingness of a central bank to act as a lender of last resort or to act as a dealer of last resort and provide liquidity to banks and or preserve their solvency, but also their propensity to allow banks to become insolvent or to actually allow banks to fail. And then after that, we're thinking about the relative propensity of governments to bail out banks using different measures or to let banks fail. So a big element of the 2008 financial crisis was that governments stepped in to provide extraordinary liquidity supports to banks through a combination of guarantees and direct bailouts and so on. And that has implications down the road. And so what I'm curious about is the implications of that dynamic in the US. I have written a lot about it in the context of Europe, but let's unbold that now and contrast that with the rest of the world. So if we're thinking here about the tensions between the core and periphery, what we see is that the circumstances are rather different. The playing field is different in terms of what extraordinary measures of liquidity different governments, different central banks can expect given their position in global hierarchies. So this is a big project. It's evolved out of a lot of things, but it's thinking especially about the political economy of what we might call fiscal space, which refers to the sustainability of fiscal deficits and government debt. And this is inextricably linked, in my opinion, from how governments provide liquidity to banks and how they may simultaneously require liquidity from central banks and other financial institutions. So when governments bear a responsibility or demonstrate a willingness to step in to support banks because banks are seen as an engine of growth or a necessary service in the functioning of an economy, that creates a challenge for governments in terms of how willing they are to let a bank fail, given the likely economic consequences that follow. And so it often involves considering the political constraints on their ability to engage in expenditure. So if we think about how certain economies might have balanced budget requirements, or alternately, how economies that accept aid packages and assistance in one form or another, that may create external constraints on their ability to spend either outside of crises or in the midst of crises. And it is likely to have implications for what kind of spending governments engage in. So if we think specifically about the example of peripheral economies in the Eurozone during the Eurozone crisis, what we saw was a prioritization in peripheral economies of paying back loans to private financial entities in core economies of the world, while those governments were simultaneously constrained from dealing with domestic crises, physical crises, economic crises, social crises, because they had to prioritize paying back bondholders of their debt. We also want to confront the reality that when governments step in to provide liquidity to banks and firms, it may make it more difficult for them to spend on other aims later. So this is linked to what I was just talking about in terms of not only thinking about how much spending governments can engage in, but also what type of spending they engage in. And then finally, acknowledging the hierarchies that better enable some governments to engage in these actions than others. And it's not as simple as what is the share of debt to GDP. Lots of other factors play in. So what is fiscal space? Fiscal space refers broadly to fiscal sustainability. What is the gap between government expenditure and government revenues? What is the government's deficit in a given year relative to GDP? And what is the government's accrued debt over time to GDP? We assume that as debt increases, fiscal space shrinks due to a variety of mechanisms. Some of it may relate to external pressures on governments to spend less. Some of it might relate to external worries about a government's ability to pay back debts over time. Some of it has to do with fears about the implications for inflation or the volatility of the currency of the economy engaged in this expenditure, and so on. But the implications in practice are that when economies fear more, rationally or not, about negative implications from reducing their fiscal space, from building up deficits and debt, that will lead likely to a decrease in certain types of expenditure that may be quite crucial to economic performance, or may be quite crucial for sustaining an economy economically, physically, socially, etc. And so what we see when we look at a lot of the literature about the global financial crisis and how governments did well and how governments did poorly is that in discussions of the core or of the developed or Western world is a lot of discussion about the benefits of counter-cyclical, saving fiscal expenditure for counter-cyclical moments. So the examples that Olivier Blanchard and others will give is that Sweden is a great example of an economy that waited until a crisis, spent a lot in the moment of crisis, and every economy should aspire to the Swedish example, because they saved fiscal expenditure for a moment when it would really, really count. But at the same time, there's a lot of discussion about the costs of not using fiscal measures to respond to crises. So simultaneous with the literature talking about how it was great that Sweden, for example, waited until a moment of crisis to spend a lot, are also discussions about the unprecedentedly low deficits to GDP observed in many other developed economies. So there are comments about the disastrously low expenditure. I am so sorry, I'm going to let my cat out of the office. So sorry about that. So discussions about, for example, the negative effects of the Tea Party in the US, which put artificial constraints on governments that had the capacity to spend. But there's less explanation or less attention given to how developing economies or other emerging economies should behave in moments of crisis when they may have pre-existing debts for whatever reason. And what we've seen in the example of the Eurozone, which is the focus of most of my past research, is that there's often just an implicit assumption that readjustment and restructuring has to happen despite whatever negative effects it may have. Okay. I'm going to come back to these questions when I'm done with the presentation, but I already see that some exciting questions are coming in. So while it may be that outside bond markets are more receptive to spending a lot in a moment of crisis if economies have low pre-existing deficits and debt, at the same time, there are real consequences for not engaging in fiscal measures in moments of crisis. And that is the problem that this narrow notion of fiscal space ignores. So how is financialization linked to fiscal space? When I talk about financialization, I'm usually thinking about financialization as the importance of banks in the economy, but also the complexity of the financial system. So both the prevalence of financial intermediation as a driver of economic growth, so thinking about the sort of finance-led model of accumulation, but also thinking about the complexity of that, and also the integration of non-financial firms and households into that market for financialized products. So when you have a more financialized system, more actors in the economy that are non-bank rely on changes in the prices of financial products that may be complicated, that may be complex, that may be opaque, that may be reliant on factors that are poorly understood or, very geographically isolated from one another. And the problem is that as financialization proceeds in an economy and as actors become more tied together, the structural importance of the financial institutions that are creating these products increases. And that provides an incentive to support those institutions in moments of crisis. If lots of actors in an economy rely on these asset prices and are going to be materially deprived if those institutions fail, that provides a strong incentive for governments to step in and bail out those institutions one way or another in times of financial crisis, when in fact those financial institutions' activity may have been what created the circumstance for the crisis in the first place. So relative regulation of banks and other...
Sorry to interrupt, just 4 minutes.
Oh, just 4 minutes. Okay, great.
Yeah, don't worry, sorry.
Thank you. This has implications in the longer run. So I just want to briefly say that this is also linked with monetary power, which is to say the relative ability of economies to set the terms of international political and economic relations, such as the ability to shift costs, the ability to set policy agendas, and also the ability to open or close borders to financial flows. And this is also linked with the notion of currency hierarchies. So the power of currency or financial assets issued by a national government in the broader global market. So relative global demand for these assets matters when it comes to thinking about fiscal space. So if there is guaranteed global demand for particular economies' assets and the demand for other economies' assets is more volatile, suddenly we have a very different circumstance for fiscal space for those disparate economies. And this is linked with the economic notion of exorbitant privilege, whereby certain economies may have an innate advantage in placing their sovereign debt with other with private bondholders and being able to forego emergency liquidity measures in times of crisis. I'm going to jump ahead and think about the global financial crisis in the core and periphery as it relates to this. So in the moment of the global financial crisis, core economies, which were much more likely to engage in financialization in the form of increased importance of banks in the economy, increased complexity of the financial products that they were consuming, acquiring, underwriting, and so on, related to the subprime mortgage crisis, were the ones who registered the first major wave of losses related to the global financial crisis. So the subprime mortgage crisis of 2007 set off a wave of mini crises across the Western world and across mostly the Northern Atlantic world, where economies were more likely to have had broadly financially liberalized systems and were more likely to have become incorporated into these networks. But early monetary responses to the crisis prioritized the interests of economies with structurally important financial sectors. So it was economies with large banks that had engaged heavily in the subprime mortgage crisis, directly and indirectly, that received direct and indirect liquidity support from the Federal Reserve. So it was largely big banks in Germany and the UK and Switzerland and so on that received sort of first line support from the Federal Reserve. And a few other economies that traditionally had been served by the IMF in other times of crisis, but had been poorly treated in the crises of the 1990s, also qualified for direct liquidity support from the Federal Reserve. So what we see is that there's this sort of political division in terms of who gets support broadly along core and peripheral lines. If an economy is deemed to be structurally important, which is strongly correlated with its being a core economy, and also having a strong financial system or having a sort of structurally important, too big to fail financial system, that increases its likelihood of getting assistance. While economies that go into crisis afterwards are more at risk of the aftershocks that resonate from, or that arise from those dynamics.
Hi, Dr. Eichacker. I'm really sorry.
Yes,
You think
I am happy to stop now. I will leave this last slide and just say that we have uneven distribution of benefits from financialization. We have uneven distribution of costs from financial crisis. And it is core economies with structurally important financial systems that are most likely to receive aid in moments of crisis. So this opens up a paradox. Should peripheral economies jump in on developing financial systems that are more prone to crisis in the pursuit of better structural support in moments of crisis? This doesn't seem intuitive to me, and I hope this is not the solution that the global system is pushing us toward. So I'm going to pause there and say thank you, and I'm so sorry for going over time.
Actually, Dr. Eichacker, I'm really sorry to do this to you because I've interrupted you twice. But if you needed like 5 more minutes, we just had a cancellation.
Oh, okay.
We literally just had a cancellation.
Oh no. Okay.
So if you would like to go on. If you don't,
you know what, I'm gonna pause there and say let's let Dr. Upadhyaya go, and then we can come back and answer questions in the Q&A period.
Okay, thank you so much.
Absolutely. Really no, don't worry.
Sorry, I was muted for some reason. Thank you so much, Dr. Eichacker. That was fantastic. I can't wait till we get to the Q&A and we get to ask you lots of questions about that. Now, I would like to introduce our next speaker and our final speaker, Dr. Upadhyaya. Dr. Upadhyaya is a research fellow at the Institute for Developmental Studies, University of Nairobi. She has a PhD and MSc in economics from SOAS, University of London, and a BA in economics from the University of Cambridge. She is a qualified CFA charter holder. Radha has over 16 years of teaching experience with particular focus on research philosophy and methods, finance and development, and entrepreneurship and development. She has written on the Kenyan banking sector, banking regulation in East Africa, African firms, African entrepreneurs, and informality. She is on the editorial board of International Journal of Technological Learning, Innovation and Development. She also has a significant private and non-profit sector experience. She spent 4 years as a director of a Kenyan bank and is currently a member of the governance body of the financial sector, Deeping Trust Kenya. Her presentation will be entitled Digital Credit in Kenya, Financial Inclusion or Financialization. And I am very excited to hear from Dr. Upadhyaya, as I'm sure we all are. Yeah, if you can jump in whenever you want, Doctor.
Okay, I don't know, can you see my screen? I think you can't.
We can't see your screen, ma'am.
Okay, but then you can't see the actual presentation, can you?
No, not yet.
Okay, just give me 1 second.
No problem.
Is that okay?
Yep, that's great.
Okay, so I'll also just start. I'll also just start my timer. So thank you very much to the REFA team for inviting me today. My name is Radha Upadhyaya. I'm a research fellow at the Institute for Development Studies, University of Nairobi. And today I'll be talking about kind of a very micro aspect of financialization, which focuses on digital credit in Kenya. I'll actually be presenting some of the research I've been doing on a project funded by Facebook through the South African HSRC. And my other colleagues on this project are Dr. Karen Weitzberg of the Institute for Advanced Studies and Linda Bonio of Lawyers Hub. And kind of a broad research question in our project is, how can digital credit in Kenya be made more responsible? So the structure of my presentation is I'll just give an overview of digital credit in Kenya, and then I'll go over two main issues, data protection issues and the regulatory debates. So what is digital credit? Digital credit is any sort of credit provided over either a mobile device or any other sort of device, like a digital device, like a computer. In Kenya, mobile credit or digital credit was first introduced in 2012 with the launch of M-Shwari, which was a product that was launched joined by a bank called NCBA and M-Pesa by Safaricom, which is a mobile payments platform. Today, it's estimated that there are almost 50 to maybe 60 mobile lending apps, but it's a very fluid space because there's so many kind of fly-by-night products that come on the Google App Store. What we can learn, or what we can say from between 2012 to now, is that digital lending has become hugely popular. Over 6 million Kenyans have borrowed at least one digital loan. And between 2016 and 2018, 86% of all loans taken by Kenyans were digital in nature. The majority of the users are male and urban. And the main use is kind of working capital, day-to-day needs, but there's recent evidence that digital credit is replacing kind of more, say, traditional forms of credit like shopkeeper credit, and also being used for more kind of lump sum expenditures like school fees. There's also evidence that that there's a lot of juggling by users. So an early study had said that about 14%, so approximately 800,000 Kenyans had multiple loans. But recent evidence has suggested that even up to 65% of Kenyans have multiple loans. This is just a small timeline of the digital lending kind of rise, so starting with Mshwari, which was launched by a bank called NCBA. Then we've had the kind of more kind of what I call Silicon Valley providers, like Silicon Valley backed providers like Tala and Branch, but also other Kenyan banks like KCB, Equity Bank, and even what you'd consider more kind of the foreign-owned banks like Barclays or now ABSA going into the space. In 2019, M-Pesa themselves started a digital credit product called Feliza, which has also become extremely popular. So what are the main concerns? Why did we apply for this grant to say we want to understand why digital credit is made more responsible? And a lot of this data is not ours. I'll give the references at the end, but it's estimated that 2.2 million individuals have non-performing loans. But 49% of the non-performing loans are less than $10. A lot of the impotence or the press, negative press about digital credit came out because people were being listed in the credit registry bureaus as, or blacklisted for very, very small loans. And we'll discuss the role of the CRBs later. There's also evidence of over-indebtedness. It has been argued that you cannot count everyone who's been listed in the CRB as over-indebted because a lot of times people are just trying to check the system. They have, so the figures of the numbers of people listed in the CRBs may be an overestimation of over-indebtedness, but there is recent evidence to show that people have given up either food or sold assets to repay a digital loan, which is considered a very kind of key indicator of over-indebtedness. Overall, they have extremely high interest rates, with ARP estimates of APR estimates of yearly interest costs of between 442% to 44%. There's a lot of concern over transparency of data use as well. Now, where I feel that this, why I wanted to, when I was asked to present here, I thought there's the link, is whilst the hope was digital credit would reduce transaction costs and, provide lending to what were normally considered unbankable populations, there is evidence, even as our interviews indicate, from someone who's been worked as a financial sector donor for a long time and is actually kind of a proponent of this digital credit, is now there's a recognition that it did emerge from the financial inclusion narrative, but there's considerable concern, and it's gone down like into a strand of financialization now. But I'd like to argue that the demand for credit shows that we just can't wish this away. We just can't either ban digital credit or kind of wish this problem away. I just wanted to give an example. This research is from research conducted by Bankable Frontier Associates. It's a slightly old report, but it's what I find is very useful is to kind of highlight when credit is useful. So this is an example in that report of someone called Esther, who, if you look at the end, she's doing well, she's borrowed, but her husband unexpectedly dies, she gets sick. She has no money for school fees, but a quick loan then helps her jumpstart the business. So the loan did help at the right time. And that same report from BFA describes when credit is helpful. I won't go through the whole list, but some of the things which it highlights, like slow credit, credit is bought rather than sold, that borrowers are aware of the debt and reminded of the debt service and obligations, are actually not characteristics of the digital credit landscape and the digital credit availability in Kenya today. So our research questions were trying to look at the legal and regulatory landscape, but kind of a broad aim is how can digital credit be made more responsible? So now for the rest of the presentation, I'll focus on two key areas: data issues and regulatory issues. Now within data issues, there are many questions, but today I'll focus on two. And the first is, basically, digital credit operates on automated systems. Are they fair and transparent, and how do they use data to assess people's risks? And the second main question is that, is digital lending really an effective means for thin file, or what I call unbankable customers, to build their financial credit or history? So when we come to the first one on automated systems, so this graphic from the Wall Street Journal kind of is a simplified version of what digital credit providers consider as good risk or bad risk and what data they collect. For example, if someone makes a call in the evening, they're probably seen as a better risk. Now, what's really important to remember is the algorithms that are used in automated lending are kind of guarded very secretly. So it's very hard for us to really know what the algorithms do, but a lot of recent data has shown that actually the data collected by digital credit providers is immense. Everything from GPS data to camera, storage capability, and contact lists. What this has led to, which I won't go into now, but is some of the very more egregious steps by some digital credit providers that borrowers were not aware of. You know, it was quite shocking to borrowers. They just accept the terms and conditions like we all do, when even very educated people will, you know, not really look at terms and conditions. But when you're not able to pay, it's quite shocking that you know, your contacts are called and pressure put on you to pay back that loan. Something interesting that our research has provided, again, I want to highlight, we're kind of in the middle of our research. We've completed most of the interviews we want to complete, but we're just really in the process of analyzing our data. But one of our interviews suggested that actually, whilst the data points collected by digital providers are very many, actually it's come to people's attention that the algorithms may be very crude, and there's evidence that they're biased. So there's, for example, a study in Tanzania points to a significant bias against women in terms of amount of credit given. But it also seems that these algorithms are not actually using very many data points. They end up all giving to the same people, and they're not being adjusted as more and more data is collected. And now touching on the next data issue of whether digital lending is an effective way for, you know, to build financial or credit history. And Kenya has a system of credit registry bureaus, and by law, credit providers are supposed to provide both positive and negative data to the credit registry bureau. But what has been found that actually the way the CRB data has been used by lenders is very binary. It's very much either, like blacklisting, and it's rarely used to say improve the borrower's credit score with positive data. And there's evidence that the data from some of the digital credit providers, the quality of that is quite weak. Now, I think the whole question of digital credit raises the question of, are the CRPs fit for purpose? Now, partly because some of these stories of people being blacklisted for very small loans actually were there much before COVID started. At the start of the COVID-19 pandemic, the CBQ banned digital providers from submitting or accessing the CRBs. Now, the aim was that people are in a shock, they are likely not to pay, so we don't want them blacklisted for that. But what has happened, and that seemed like a reasonable, logical way to deal with the issue, but actually its consequences have been quite problematic, because what digital lending apps have done is they've immediately suspended their loan limits, and we've interviewed people who have in turn interviewed borrowers who found that the positive credit histories they built are no longer useful, and they're not able to get loans. So the idea of how to make CRBs fit for purpose still remains quite a complicated question. I'll next go into the regulatory debates, and again, a kind of these debates are actually going on in Kenya as we speak. But I just wanted to give a bit of history of some of the regulation of mobile lending in Kenya. We have a Microfinance Act, which didn't really come into place. But in 2018, there was a Financial Market Conduct Bill, FMCA, that was proposed by Treasury, and that kind of proposed what's called a twin peak model, where a central bank regulates the prudential regulation, but another body provides kind of market conduct and consumer protection oversight. There was no appetite for this, and it's been dropped. Now, as we speak, there's a Central Bank of Kenya amendment bill that's going through Parliament. There are many people who've given their comments on it, and the Parliamentary Finance Committee has recently given out its opinion on this amendment bill. Now, what final shape it will take is still not very known, but this bill envisages digital credit being regulated by the Central Bank of Kenya. But what form will this regulation take? Now, I think this is a very interesting example because Kenya is at the forefront of digital credit. Normally, when you do any other work in a developing country, you can pick best case scenarios from other emerging countries, but we are actually the place where this is kind of happening like ahead of many other countries. So there are no easy solutions that we can pick from other countries. But what is recognized that because there's an absence of an overarching regulatory framework, anyone can lend. And as one of our interviews said, currently there's no disincentive for providers to behave in a short-termist way and make quick profits with high defaults. Within the regulatory space, there are kind of two debates. One is what I've called the rules-based versus outcome-based approach, and another debate is the self-regulation versus central regulation. Now, it's been argued in literature, but also in some of our interviews, that an outcomes-based approach is better than a rules-based approach. A rules-based approach where there's a poacher versus a gamekeeper sort of dynamic is not useful and often leads to mock compliance. But what's really not clear is what would an outcomes-based approach mean in the context of Kenya? So some of the things that we've have been emphasized in our interviews is there needs to be incentives for providers to build a responsible long-term credit business where consumer protection and transparency are key. Users need to know the true cost of borrowing. I'd shown you the extremely high APRs at the beginning, but it's not clear that between the different costs and charges and fees that borrowers actually know the true cost. And the regulator still has to have some teeth, which may mean some sort of a licensing approach. However, the second debate is linked to the first debate. It is recognized that with between over 50 to 100 providers, it's not clear that the Central Bank of Kenya or any other authority would have the capacity to regulate these lenders. There's a body called the Digital Lenders Association of Kenya that is really pushing and campaigning for self-regulation, but within our interviews and within the literature, there has been a discussion that self-regulation often leads to a race to the bottom. So what we see as kind of maybe a kind of not a middle ground, but something that's would kind of make it more workable is for a regulatory space to see what can be delegated and what can be not delegated. One of our interviews referred to this idea of trying to build a garden of trust, but the providers must earn this trust. Now, again, you can see that this is kind of sounds quite nice in theory, but actually in practice is very complicated to implement. But what is also clear is that the evidence is that financial education, there's little evidence that financial education helps. So the onus must be on the providers to be transparent. So I think I've just reached my 20 minutes. So I'll just leave you with the final, which I feel is this key challenge for developing country systems, and even more because of COVID, is we need to design financial systems that give credit, but don't cause over-indebtedness and still support the real economy. And how to do that is something that's a real challenge, and I hope we'll have a good discussion on that. Thank you.
Thank you so much, Dr. Upadhyaya. That was a great presentation. And I think for me personally, it was very interesting to get more of a micro perspective on financialization, etc., because usually the issue is so it's usually directed at the global economy and things and broad macro issues, which are incredibly important. But I think that is a very salient presentation on very like you said, Kenya is on the forefront of financialization within the developing world. So I think those are issues that we will all have to think about very soon. And yeah, thank you so much for your presentation to both of our speakers so far. We have until 1:15, so we have quite a few questions. I'll try to ask one directed to Dr. Eichacker, then one directed to you, Dr. Upadhyaya, and then, like that. And hopefully we can get through as many of these as possible before the time is up, if that's okay with you guys. Okay, I think just to continue the same order, I think we'll start with Dr. Eichacker. We have a question from Jared Osoro. He says, Dr. Eichacker, he says that you distinguish a financial crisis turning into a fiscal crisis from a financial crisis leading into a fiscal crisis. What are your thoughts around a vicious cycle that runs from a financial crisis leading to a sovereign crisis and then turns into a growth crisis, which compounds the financial crisis, that has the possibility of affecting the financial sector and the fiscal position simultaneously? Is that?
Yeah, this is a fantastic question, Jared. Thank you so much for putting it forward. I think first of all, I may have given a misleading impression of a financial crisis turning into a financial crisis being different from a financial crisis leading into a financial crisis turning into a fiscal crisis versus a financial crisis leading into a fiscal crisis. But I think it's important to note that fiscal crises can result from any number of causes. So we can see a financial crisis begetting a broader economic crisis that leads to a fiscal crisis, but we can also imagine a scenario such as the COVID crisis where a physical crisis begets the fiscal crisis if governments are constrained in their ability to spend in response. And something that has been surprising to me, at least in the developed world, where there has been a trend towards increased austerity in the past decades, in the past decade and a half or so, is that core economies have seemed to be more disposed to spending more, and there seem to be some promising signs in leadership of the IMF in terms of a willingness to stand by and allow governments to spend more. And it's more complicated than that, obviously. But to your question, how to deal with the vicious cycle of financial crises leading to sovereign crises that then cause further growth crises that compound financial crises is, I think, a really fundamental question. And I agree that there are strong reasons. I believe that there are strong reasons to preserve and empower fiscal expenditure to whatever degree possible. And so what that means is not leaving governments on the hook to whatever degree possible in terms of bailing out financial systems. So first of all, and this is going to the question that I believe Benga Falana brought up, is that I think that to whatever degree possible, central banks should be the ones in charge of dealing with monetary issues, should be the ones in charge of dealing with the sort of financial fallout from crises. I think that when governments which have obligations to deal with the economic fallout from a financial crisis are simultaneously trying to sustain a financial system, that compounds problems. Usually the financial problems are revealed to be larger than expected, and governments are suddenly funneling potentially constrained resources to a financial system that might be more productively spent on populations at large. So to whatever degree possible, preserving government's ability to spend is crucial. I also believe that proactive grants, to allow for government expenditure before crises happen is a really, really important strategy. So, there's been debate in the context of the COVID crisis about the relative desirability of loans with reasonable terms, such as interest-free loans with long time horizons for payback versus grants. And I think to whatever degree possible, giving grants is the better solution because it enables more proactive expenditure without compounding the risk of volatility in the future, inhibiting a government's ability to use those resources to spend on the causes of the crisis or on the bigger effects of the crisis. And throughout all of this, I think that the key assumption is that when governments receive bailouts, when governments receive loans or grants from institutions like the IMF or like larger economic bodies, they should not be tied to expectations of restructuring of economies, of austerity measures, and so on. I think delinking aid from the sort of Washington consensus notion that government expenditure must be limited for economies to operate effectively, that labor markets must be lean in order to promote efficiency. I think that all of that theoretical, the theoretical and ideological dogma has to be excised from these aid mechanisms, because crises are never the moment. Are never the moment to engage in those measures. So I'm gonna stop there. I think that's a great question, and frankly, I think it's inspired. I mean, I think it's a big and unanswered question, and one that merits a lot more attention going forward.
Thank you so much, Dr. Eichacker. I think that was a very thorough answer, and I mean, I think it's a very interesting a point that when you say that crises are never the moment to engage. If there is a moment to engage in things like restructuring, etc., crises are not the moment to do so. Probably the worst time to get involved in that. I think that's a really interesting observation, and I actually think I've never heard that. So that was a great answer. Thank you so much. Now, Dr. Upadhyaya, we have a question from one Laura Mann. She's wondering whether either the government or international non-commercial actors have voiced any interest in mandating the transfer of private sector data to design non-profitable financial services to more vulnerable groups, which private sector actors would not be interested in. I suppose, yeah. Do you follow the question?
Yeah, thank you very much, Professor Mann, for the question, and thank you everyone who's attended. Whilst no, I have actually not heard of anyone pushing for governments to kind of anyone, either government or a donor, pushing for private sector to transfer this data to help design a non-profit solution for more vulnerable groups. What I have seen is calls for, or it came out in our interviews, is calls for more clarity in how the data is, so for the user to have clarity in what their data is being used for, and it to be more obvious. But also in some of our interviews, the idea that the algorithms should be made more open, like what you're collecting all this data, but then what actually is the algorithm, to be more as kind of an open source idea, which I do think is interesting, because then if there are biases against women or against certain groups in the algorithms, that shows out. But this sort of data is protected like a gold mine that it is. So no, I haven't seen any calls. What I haven't seen calls for either is kind of having a more kind of cooperative way of organizing, a sort of a digital credit provider that's kind of non-profit or owned in a cooperative way either. What I'll do is, I realized, because I stopped sharing, I didn't give the references, and I think someone's asking for the references in the chat. Is it better if I put the references in the Q&A or in the chat?
I think it would be better in the chat, Dr. Upadhyaya.
Okay. So I'll just copy that.
Dr. Upadhyaya, I mean, if I could ask a follow-up question. You mentioned that you think it's a bit odd that there have been no more cooperative ventures to establish digital lending, etc. Does such a cooperative system have precedent anywhere else in the world? Are there examples of such a setup in other places?
So I'm actually very, very much a Kenya specialist. I don't know about other countries, but Kenya itself has a very much like smaller scale cooperatives, whether it's what we call VOSCAs, rotating savings groups, or SACCOs. They're all very, very used and popular. And some of the research in Kenya has shown that actually people have quite rich financial lives, like some what I call the financial diaries research. There was also so people will have a digital credit loan and a SACCO and a ROSCA. But I think the idea that there is, I think, some nascent movements to try maybe say digitize SACCOs, but it's more about the records rather than it being kind of a digital lending platform. Maybe the scale isn't there for and a lot of cooperatives fail when they go to a higher scale. So that is a key issue as well. But I think it's also the idea that I think Kenyans very much our ideology, and we're very much a market-led economy. But yeah, I find it very troubling that we went, this credit is needed, so the solution should have been there, but partly because the regulation has fallen behind and the regulation is so complicated, a lot of the harms have come into place before even the industry has kind of grown, or matured,
Thank you so much, Dr. Upadhyaya. There's about 10 minutes left. So I think it might be hard to fit in a question each. So I think there's one question that's, I think, broad enough that maybe both of you guys could, answer that question, if that's okay. Okay, from an anonymous attendee, they want to ask, and I think it's very salient in these like post-neoliberal era that we're in, a lot of people would be interested in the issue of, can we reverse financialization in marginalized/developing countries? Does a global system with structural power imbalances limit the ability to do so? So either one of you can go first, I suppose.
I'm happy to take a first attempt at it. It's a great question, and it's complicated, as the asker no doubt knows. So can we reverse financialization in marginalized or developing countries? I would say more broadly, can we reverse elements of financialization in marginalized and developed countries? I mean, I think that those are two slightly distinct questions. So the means by which developed economies engage in financialization or financializing practices may be different in form than how developing economies are incorporated directly or indirectly with agency or declined agency in the process. So the short answer, I would say, is there's a lot that has changed very, very comprehensively. But I think that there are measures. That can perhaps be implemented in ways that minimize the negative aspects of financialization to the benefit of developing economies and developed economies. Now, I believe that it is difficult to actually implement those policies, as the anonymous attendee notes, because of power imbalances. And we can think about power imbalances both in the sense that financial interests that have historically lobbied for the implementation or for conversely the elimination of measures that constrained financial activity tend to have a lot of lobbying power. Another attendee noted that there's a problem in that there are a lot of people who come from the private financial industry who then take jobs in government positions or take positions within central banks and so on. And this is a big issue in the US. And it's not guaranteed that someone who comes from the private financial sector is going to promote deregulation and overwhelmingly, I don't know, bad negative policies. I've been personally very pleasantly surprised by recommendations of people in the current presidential administration of the US who are coming from finance, who are promoting broadly beneficial, and I'm as surprised as anyone to say that. But I don't think it usually works out that way. So I think that there are controls, like we can think about, I think broadly allowing governments more autonomy to direct how they shape their financial systems is really important. I think that the fundamental elements, or I think that the guiding ideology of liberalized finance in broad aid organizations is a huge problem. And I think that when the IMF and World Bank and other institutions mandate the elimination of controls, mandate the deregulation of institutions that a state may know better how to approach or may understand the risks of better, that is a huge source of problems. That is an example of power from outside shifting the terms in ways that will have destructive implications or destabilizing implications. And so I think that to whatever degree possible, lending more financial autonomy to governments that are better positioned to see the risks at hand is a crucial element in terms of limiting the negative elements of financialization and financial globalization. Because I think it's probably impossible to undo financialization because it is such a comprehensive thing at so many levels, at the micro level that Dr. Upadhyaya is mentioning, at the national level, and at the sort of global meso level, that I think that process would be very complicated. But I'll hold there and transfer over.
Thanks so much, Dr. Eichacker. That was a great answer, and somewhat bleak at the end, but that's okay. Dr. Upadhyaya, would you like to take a stab at the question as well?
So I agree. I see the financialization very much as the process when finance capital dominates industrial capital, leading to increased fragility of the economies. What has been challenging, and it's I'd written a chapter in a handbook, and actually in developing countries where the overall private credit on GDP ratio is quite low, it's actually in a way hard to argue about. It's even like harder to find evidence for financialization. So for me, like I've been almost looking for it, but not finding it till the whole digital credit took off. And it's quite sad because in a way we do need higher credit on GDP, but because these are very micro loans that are only aimed for, that then means are only used for personal use, which I'm not saying is not necessarily the real economy, but they're not, then I think the definition of consumption should be thought of a bit differently in developing countries. But I think the idea is, and something Professor Eichacker said is, I think rather than focusing on reversing financialization, I think the idea is to make sure that the harms are minimized. So in Kenya, our focus has very much been on financial inclusion, and we've made huge strides in financial inclusion, but that's not enough, because like the last FinAccess study showed that though financial inclusion had increased, financial health had gone down. So it's also where we keep our focus, and recognizing that finance can only help if it also helps and supports the real economy. So, linked with some sort of an industrial policy at a broader level and at the micro level to make sure that some of these harms are minimized is really important.
I think that is very salient wisdom. And I think yes, I think it's very interesting how you bring up that consumption maybe needs to be thought of in a different way in the context of developing economies. And yeah, I think that was a great answer. Thank you so much, Dr. Upadhyaya. I think with the very little time we have left, I think this is a natural stopping point. I would really like to thank both of our panelists today, Dr. Eichacker and Dr. Upadhyaya. You guys have been fantastic and loved your presentations. I'd also like to thank everyone who came to check out the session. I think we had a really successful one and we had lots of great questions. I'm sorry that we didn't get to answer all of them, but that's kind of the nature of these things. And yeah, do not forget to check out the rest of the festival. There'll be, beginning at past, we'll have session 4 of a lot of the different streams. Please go and check those out. There's lots of really interesting sessions to come, lots of great panelists, just like the ones that we've had here. And thank you so much, everyone. I think.
Thank you. I put my email in the chat. So if there's any question that, I don't think there's other one specifically to me, but I'd be really happy to connect with all the participants. And thank you so much for inviting me.
It's really nice to meet both of you. Sorry.
I would just like to second what Dr. Upadhyaya is saying. Thank you so much for hosting. I've also put my email address in the chat. So if you have queries, please don't hesitate to get in touch.
Thank you so much to everyone. And yeah, I hope you all have a great day and a great rest of the festival.
Thanks again.
Thank you.
Bye.